Well, let's get started. Thanks everybody for joining this afternoon before the holidays. I'm really excited to have Jared and Adam from Brown Rudnick to talk to you about the do's and don'ts about pitching. As you know, now, I don't know about you, but I hear a lot of, looking for funding at around this time. This environment can be harder than it already was hard before, but I think now it's even harder. And so getting an insight from somebody like Jared, who has worked with a lot of startup and investor, will be so helpful. And Jared will share with you he promised to share with you a lot of the horror story and then not so horror story, or the best practice. And I'm looking forward to learn from him as well. And a quick introduction, you all probably know Adam before, because Adam was always very kind to help to drive the conversation. Adam is a partner at Brown Rudnick, and his focus area is in IP. And so even though that is his focus area, but he also worked with a lot of the startup, and so he will manning a lot of the Q&A section. So if you have any question during the talk, feel free to put it in the Q&A box, and Adam will drive that conversation. So I just also wants to give you a heads up that this talk is slightly different from any of our other talks. We're going to draft a lot of the conversation based on the question that comes from you as well. So please do provide that question in the Q&A box. And so our star today, in addition to Adam, is Jared Sorin. Jared is also a partner at Brown Rudnick. He is in the corporate practice group. And so he worked with a lot of startup emerging growth companies, as well as the venture capital group. And so he has helped a lot of the startup company and the ventures to be part of the debt and equity financing transactions. So he's seen a lot of the do's and don'ts of how to negotiate, how to talk to investor and vice versa, and understanding a lot of the different securities laws and corporate financing in general and how you structure your deal. So with that, I'll give the floor to you both, and I'll just be on the background.
Perfect. Adam, do you want me to kick off, or do you want to say anything?
Yeah.
All right. Well, thank you, Christine and Herminio and everyone here for having us here to speak with you. Adam, thanks for including me. Christine just shared my background. Just by way of brief additional background, I co-lead the venture capital and emerging growth companies practice group at Brown Rudnick. So we are focused on really startup, early stage, emerging growth, tech-enabled and life science companies, as well as the investors who support them. So on the company side, we're representing companies literally from the pre-formation stage, the napkin stage, so to speak, through the various capital raising transactions, which is where I spend probably most of my time, through whatever the ultimate maturity or monetization event might be. On the investor side, we represent investors who invest in really every stage of a company's development, from pre-seed and seed investors to very late stage venture funds. Christine said this. Before I dive in, let me sort of reiterate, I want to make this as useful to you as you want it to be. Please jump in with any questions, comments, things you want me to touch on. Happy to make this conversational, so to speak. But we want to be a resource for you and answer whatever questions you have. Think about what's on your mind. And we love talking about this stuff. So whether you have questions now or they come up later, please don't hesitate to reach out to us. We'd love to continue the conversation with each of you. So during this conversation, we will talk about a handful of the things that investors need to see from a founder or founding team in order to get that investor to actually say yes, to get them to invest into your company. We'll discuss the skills necessary in order to effectively pitch these investors. And we'll talk about a handful of the things that the investors need to not see in order to keep them from saying no. I think it's important to take a very broad, holistic view of what it means to pitch an investor. We talked about this before this session, but when people think about pitching investors, they tend to think of the actual pitch meeting, right? Where the meeting where you sit down with an investor and the founder describes their business and fields questions from that investor. The reality is that the pitch starts way before that meeting. It starts from the initial introduction. It continues through the sharing of pitch decks and executive summaries and any other materials that you might share. It continues through that first meeting with the investor and through the subsequent meetings that you'll likely have with that investor before they say yes. If the investor is not an immediate fit, the pitch doesn't stop, right? It's very rare for an investor to give a hard no. It could be a not yet. In that case, you continue the pitch by sending periodic updates. It continues even after you get the yes, from the term sheet stage through the negotiation of the deal documents, and you get the point. Pitching investors is a big and long undertaking. You want to be prepared for it. It is not just one meeting. Entrepreneurs often find the prospect of pitching investors to be stressful and intimidating, and who could blame them? Investors, especially seasoned investors, they know the questions to ask. And for entrepreneurs, particularly first-time entrepreneurs, this can be very intimidating. That said, pitching is a learnable skill that can be honed. And at the end of the day, it's really all about storytelling. If you can tell a compelling story, if you know your business, you can cover the key points that the investors want to hear, it can go very well for you. The more comfortable you are with the business, the more you understand the business and the market, etc., the easier and more effective your pitch will be. So again, it really is important to tell the story of your company. It's important to do that clearly and succinctly. This starts with having a really solid elevator pitch. I can't tell you that, here's one of the first horror stories. I can't tell you the number of times where I will have a pitch with a client where I ask them what they do as a company, and they go off on a 10-minute word vomit where I don't learn a thing about what they actually do, where I just don't understand the business at the end of that 10 minutes. If you have no idea what the company does after the founder talks for that long, it's a problem, right? That should not happen. You should be able to recite your elevator pitch on cue. And it should be short. It should be 30 seconds. It should be a minute. And that is very much a practicable skill. Again, the pitch can start anywhere. Maybe you meet an investor at a networking event. Maybe you've been introduced to the investor by a mutual contact. Those mutual contacts are often entrepreneurs who are already in the investor's portfolio, or service providers like lawyers and accountants. So some of these hypotheticals, right? If you're at a conference or otherwise find yourself face-to-face with an investor for the first time, your initial pitch is likely to be 30 seconds to a minute, not much more than that. And I'm sure I don't need to say this to the group, but if you're trying to meet an investor at a conference, please maintain social etiquette. I've seen this movie 1,000 times, right? Where you're at an event, a handful of investors finish a panel discussion, they step off the stage to a swarm of 50 entrepreneurs who want to speak to them. It happens at every event. I don't suggest you be part of that group. I do suggest that you find another opportunity during that event to say hello, introduce yourself, to any investor that you're interested in potentially pitching, and having a brief conversation there. Follow that up, with a follow-up email or call to continue that conversation. But that conversation, again, is only a few minutes long. And in that short period of time, your goal is to tell the investor clearly and articulately and succinctly what your business does. The goal is not to spew as much information as humanly possible in that short period of time. That sounds obvious, but again, it happens all the time. This is the true elevator pitch, right? This is not the time to ask for money. This is relationship building. This is the time to start fostering that relationship. If the investor is receptive, you ask him if it would be okay to follow up and continue the conversation. Then this shouldn't need to be said, but do follow up. Right? That happens all the time too, where you might actually get an investor who is interested and then the company fails to follow up for whatever reason. That follow-up, yeah, sorry, go ahead, Adam.
All right, there's a question that's come in. How often do you still hear people say, or as part of their pitch, we are the Uber of technology, or we are the Facebook of, and is that still the way people are elevator pitching in a way that's successful, or do people need to be more honest?
I think people should be more honest. That is a useful statement when it's genuinely true. I think sometimes, it is helpful to think about it. If you truly are the Uber of X, if it's sort of immediately understandable to the person that you're speaking to, then it could be useful. And I think some investors might say, don't ever do that. But if it is truly descriptive of what you do, I don't know that I have an issue with doing that. Where I sort of scoff is when you say you're the Uber of X and then you describe your business and there's no obvious connection to how you're the Uber of whatever. So I would just be mindful of that. I wouldn't force yourself into saying you're the X of Y, because if it's not true, then it's just confusing.
Yeah, another question that's come in. What's the best way to deal with investors that are not responsive or ghost you? They said they'd send you an email, but they don't do it.
They said that they will send you an email, but then they don't. I would follow up maybe a couple of times after a reasonable amount of time. But then, at some point you stop because it's not worth your time. Oftentimes our clients will create sort of a monthly or quarterly update that they'll send around to their network. Maybe you add that investor to that quarterly update. That way, maybe you stay in their minds, and maybe it just wasn't the right time for them when you did pitch them, and maybe they'll keep you in mind, as you go forward. That's sort of why investors almost never give a hard no. Like I said before, right? They want to keep the door open to see where a company might go, and if the company might not be in their space or in their stage of development or ready for their investment when you pitch them, that doesn't mean you never will be. So you want to keep the door open. Obviously you don't want to burn bridges with people. So I would say follow up a couple of times. Investors get a whole lot of emails. They get thousands of pitch decks every year. It's easy to miss emails. So I think give them the benefit of the doubt there. Follow up a couple of times after a week or so, and then move on. But maybe keep them up to date. So where were we? Any other questions? Sorry, before I move on.
Yeah, another one that's come in. How much advanced research should you be doing with an investor before approaching them or deciding that it makes sense to approach that type of investor?
That is a really great question that I have in my notes somewhere here. You should absolutely be doing research on the investors that you're interested in pitching. We'll talk about this in a little bit, but suffice it to say for right now that yes, there's a lot of information available about investors. When you do your homework, you can customize your pitch to the specific wants of an investor. That doesn't mean you lie to say what they want you to hear, but you can emphasize the things that that they like. And frankly, it'll save time for you and for them if you do some research and confirm that they are in fact a right fit for you. Right? You shouldn't be a fintech company that's seeking investments from biotech funds. Right? You don't want to waste your time. You don't want to waste their time. So doing your homework, understanding that they are, investors who invest in the stage of development that you're in, understanding the size checks that they might write, understanding if they have any geographic preferences. All of that is stuff that you can find reasonably quickly with a Google search.
That's a really good point too, that right when we talk about the pitch is basically the same. It has the same skeleton, but it does become nuanced for each investor you're talking to. You can't just give the same talk to every single investor.
No, it wouldn't make sense, right? You will pitch investors who have different skill sets, who have different background knowledge, and you need to sort of tailor your pitch. The bones are the same, to Adam's point, but you tailor the pitch to the specifics, to the knowledge, to the expertise of the investor, so that you're not giving them information that they don't need or want. Okay, so we talked just then about that 30-second pitch you might do at a conference. The follow-up email is really important as part of the pitch as well. That's the meeting, or sorry, that's the email that you'll send after that meeting, or maybe it's the first outreach to an investor if you haven't met them at a conference, where you might send them your pitch deck and your executive summary or your executive summary, and suggest a meeting. If you're being introduced to an investor through a warm introduction, it is your pitch deck or your executive summary that will be the first thing that the investor sees about your company. And so it's important that it looks the way it should. It's important to clearly communicate the high level things that investors want to know about a company. I hate this to some degree, but it's important that that document looks standard and meet standard expectations. A pitch deck in general shouldn't be more than 15 to 20 slides. An executive summary should be a one-pager. Just a one quick thing, when service providers are the ones who share the pitch deck with investors, any service provider that promises you that they're going to find you money is a liar, and you can run away from that person. As a service provider who often is the one making introductions and sharing pitch decks, it's really important that we be smart and careful about what we send and to whom we send it. So I guess one thing to be mindful of, right? How about investment bankers? Same logic. Please do not confuse activity for progress. Some service providers will share the pitch deck that you send them with every investor in their network. And it might feel good to say, hey, Joe Smith just sent my pitch deck to 50 different investors. But if they're not thinking about which investors might actually be a good fit for the company, it benefits nobody. Right? It's a waste of time. It's a waste of the investor's time. It's a waste of your time. And frankly, it ruins the credibility of that service provider who's making the introduction. So, our promise to our clients is that we will open our networks to them. We will make more meaningful introductions where they make sense, and we will not send you on a wild goose chase. Our investor clients and friends know that because we only send them stuff that we genuinely think that they would be interested in, they in turn promise us that they will give it a real read. So, it gets on their desk, in front of their eyes. That doesn't mean that it's a yes, right? Ultimately, that's a business decision to, work out between you and them to make sure that it's actually a good fit. From a procedural perspective, when we send these sorts of decks out, we usually send the deck and the one-pager first to the investor before we make an introduction, just to not put the investor in an uncomfortable position of being introduced to someone that they may have reason not to want to be introduced to. Are there any other questions?
Though, Jared, like the need for a non-confidential version to share, and that most investors very much want to get a look at a company without having to go under confidentiality for it because of the ecosystem in which we all live in, and the different looks, as you mentioned, with the different technologies that are out there. And so being able to have different versions and different levels of confidentiality in the way you summarize and tell about your materials is really helpful.
Yeah, and we'll talk about confidentiality in a couple of minutes too. I think it's a huge point. You want to make sure that you are not sharing confidential information prematurely.
Yeah. Another question that's come in. What are your thoughts on companies that when they present to investors, it's more of a monologue? And should it be more interactive? Is it best that it's just a running commentary?
Yeah, so I guess that's a hard one, because I think my instinct would be to say that if it's conversational, that means the investor is engaged and interested, and that's a good sign. But there are some investors who are just the sort to sit back and listen first. So I wouldn't necessarily freak out if you're in that meeting and you have an investor who's looking at you and not really responding. Hopefully they're nodding along and paying attention. But I wouldn't stress in that moment about the fact that you are speaking. Right? You obviously want to be mindful of it. You don't want to ramble on. But if you are sharing information that you know an investor would want to hear, don't be discouraged by that. But honestly, I think it's best when the investor is engaged, and the way that they might show engagement, maybe through participating in the conversation, but it may be through nodding along, and that might give you the affirmation that you need, that you're on the right track here.
Well, that's to your point you made at the beginning about composure and the way you present, which is don't make the assumption about the reactions to who they are. I mean, you have to get through the pitch as if this is the final sale and that they love it, because whether you believe it or not, it's a small ecosystem. And so you've got to get yourself through it, even if it's not going the way you thought it would go. One, they might be interested, but even if they're not, you're going to be pitching to people they know. And so you can't all of a sudden shut down or not get through it, or just sort of say, look, I believe this investor is blowing me off, so I'm going to blow off the rest of this. It's the fastest way to get a negative reputation in a small community.
Such a good point. Really, really good point. All right. So unless there are other questions, maybe the next topic that we should talk about are the things or the topics that are likely to come up during these pitches. The things that you'll want to highlight, not only in the conversation, but in your pitch deck as well. Start with the obvious, right? The business idea. You need to articulate the business opportunity in a way that's easy to digest. Understand and be ready to speak about things like market size and opportunity. Being able to speak about this stuff will demonstrate the company's potential value, and being able to demonstrate early traction will help to validate the business. If you want to raise outside capital, you will need to demonstrate that the company is a financeable company. It's worth noting, I think, that a company can be a great company without being a financeable company. Right? An investor client of mine always says, not every idea supports a business, and not every business is a financeable one. In order to attract institutional capital, the investor will need to understand the value of the solution relative to the problem, potential market size, scalability, competitive landscape, whatever other observable performance metrics there are with things like revenue and market acceptance, etc. You should be sure to highlight the things that are most exciting about your company. For many companies, especially early stage companies, investors will want to talk through your IP strategy and portfolio. If you are a tech-enabled life science company, the IP is likely to be among your most valuable assets. So you want to talk about the types of intellectual property that the company has. Is that patents, trademarks, copyrights, trade secrets, etc. You want to think about who is developing this intellectual property. You want to think about and talk about what actions you have taken to safeguard that intellectual property. For example, has everyone involved in developing the intellectual property affirmatively assigned that intellectual property to the company? Investors will want to see that you've given real thought to your IP strategy. I'll pause there for a second to give maybe the worst horror story that I've ever seen in my career. Adam, you might have heard this one already. I represented a company 5 years ago now, maybe, only on the sale of their company. And I like to make that point very clear for a reason that will become obvious in 10 seconds. We represented them only on the sale of their company. There was one founder, he owned 95% of the company. His dad owned 4% of the company, and there was an advisor who owned 1% of the company. There was a potential $100 million exit on the table. And so obviously this family is about to have, a really amazing exit, right? They're going to walk away with almost all of that money. The investor does its due diligence in a connection with the M&A deal. and asks for every invention assignment agreement that the company ever executed from inception. So every document where an employee or a consultant who created intellectual property for the company actually assigned whatever intellectual property that they created to the company. With respect to employees, the law basically says that an employee who creates anything for their employer within the scope of business, using company resources, etc., automatically assigns that intellectual property by operation of law. That said, you still must have this document because investors and acquirers are going to want to see it. The law is exactly the opposite when it comes to consultants. The rule is he or she or it who creates it owns it unless there's an agreement to the contrary. So our founder had never had any employer consultant sign an invention assignment agreement. That was a big mistake. And the reason why I wanted it to be clear that we didn't represent them at the time. This company has a potential $100 million exit on the table, but the acquirer says there's a break in the chain of title to your intellectual property, and that's why you're valuable, technology company. And so they said, basically, go and get invention assignment agreements from all of your current and former employees and consultants, or we have no choice but to walk away. So our founder had to go to every current and former employee and consultant and ask them to sign this invention assignment agreement. You can imagine what the responses were, particularly from former employees and consultants who were not really incentivized to sign this document now. They told him that he had to pay them. And he paid about $10 million to buy invention assignment agreements from these people. It's worth noting that invention assignment agreements are very standard. And if you're onboarding someone, when you onboard them, have them sign an invention assignment agreement. They're very likely to sign it when you're giving them something of value, whether that's equity in the company or a salary, whatever the case may be. There may be some negotiation around the edges, but they are almost certainly going to sign it. And if they don't, that would be a big red flag and enough of a reason for you to potentially walk away at that moment before they've actually created any intellectual property for the company. So investors, they're going to want to see all of this. So you want to make sure that your intellectual property is very carefully safeguarded.
As a biased IP attorney, I'll say, this is where everyone at some point has been given the exact same advice of, if I have a slide on IP in my pitch deck, then I've met that criteria, which really tells no one anything about it. You don't necessarily need more than a slide, but you should be able to be more creative than simply, this is the fact that I have filed IP, or giving people patent numbers or things of that nature. It should be as creative as the rest of the pitch presentation. It doesn't need to be more than one slide, but it should be something that is readily understood by the individual viewing it in the context of the presentation you're giving. Because just to simply say, we have IP, tells no one anything about it, nor does it, express the value that IP may be to who you're going to be as a company.
Exactly. So it's really important talking about your IP. It's also really important that you just know your business. Right? During the meeting with the investor, you should be prepared to answer questions about your business generally. How did you come up with the idea? What's the problem that you're solving? Who are your customers and your potential customers? Who are your competitors? We sort of talked about this a little bit, but in a pitch meeting, you are likely to get interrupted a lot. And again, I think that's a good sign, right? That means the investor is engaged. You'll want to be able to answer questions that they have, and you should do your best to anticipate the questions that they may ask. Investors will also appreciate it if you're capable of thinking on your feet, coming up with a strong answer on the spot. That said, do not try to evade hard questions with roundabout answers. If you really don't know the answer, try your best to consider it thoughtfully on the spot. But if necessary, don't guess. Don't sort of throw buzzwords around. Think about it after the meeting and follow up. I think most rational investors don't expect you to have every answer right off the tip of your tongue to every question that they could possibly come up with.
Yeah, the one I see that comes in all the time is when the person pitching inevitably puts up the slide that shows what their revenue projection is going to be, and it always moves in an exponential curve. And the question that I always hear asked is, how realistic is that? Does it account for factors X, Y, and Z? What's the best way to think about that slide in the presentation? Because it feels like from the investor perspective, who generally have a business background, it always seems to be the place where the person pitching falls down the most with respect to sort of background knowledge.
Yeah, I think that's exactly right. And I actually think it's the last thing that I was going to say, but I'll say it now. Be realistic, please. It stands to reason that you will value your company highly. You should be bullish on your company, but at the end of the day, you should try to be realistic and you should try to think about things from the investor's perspective. Going to an investor with crazy projections or seeking valuations that are just not practical is an easy way to scare off investors. So thinking from their perspective, I think, is really important. Thinking from an objective third party's perspective is important. I think having trusted advisors is really useful in that regard. Right? Again, it's human nature to value our own things highly, but an outsider should be able to help you, an advisor should be able to help you sort of come back down to ground and be realistic in your projections. I guess a semi-related horror story that I dealt with was a company that raised a lot of money from non-sophisticated investors in their first seed round. They raised about $5 million at about a $50 million valuation. Which was not well thought out, and it was not a reflection of the actual value of the company. So when they needed more money, the next round investors came along who were more sophisticated investors, venture capitalists, and they said, I love this company, but not at a $70 million valuation. I love this company at a $5 million valuation, or whatever it was in the circumstance. That was a really bad scenario for this company, right? They now are in a position where they might have to do a really significant down round, where either they cram down their existing investors or the common stockholders suffer really significant dilution as a result of the down round. In that case, the new investors
coming in on this topic, Jared. So I want to interrupt you for a second. First question that came in is, how much do investors actually look into revenue projections for an early stage company, and how much is covered in a first pitch presentation?
Yeah, so it's a really good question. I think it ultimately depends on the industry. For a really early stage company, they're probably not, especially in the tech world, they're probably not looking at revenue at all. You probably don't have revenue when you're seeking your pre-seed or seed financing round. And so, it's a factor, something that they would think about, but they're not doing the true sort of discounted cash flow analysis at that time.
So there's another question that relates to that, which comes in and says, how do you determine a reasonable valuation cap? And should basically the present economics in the world, whether higher, lower, or like now, adjust the way you look at that?
That is truly the question, right? For a really early stage company, I'm going to go off into some legalese here. I'll try to keep it clear. For a truly very early stage company, it is exceedingly difficult to determine valuation, right? At the end of the day, we don't know because the company hasn't had the opportunity to hit those observable performance metrics that I mentioned before, right? So there's not readily ascertainable information with which to measure value. So there are alternative securities that you might use for your true earliest stage round, like a convertible note or a SAFE, a simple agreement for future equity, that allow you to kick the can down the road in terms of determining valuation. So Adam, you said valuation cap, which suggests that this person who wrote this comment is actually thinking about a SAFE or some other convertible security. And I think that's right. I think that is a smart thing to be thinking about, especially in the early stages where we don't know what the valuation is. and in this market where, it's hard to project where the valuations will be, right? I think we're going to have some companies in an uncomfortable spot in a year from now when they raised at really high valuations 6 months or a year ago. And now the market is sort of saying that the valuations aren't that high anymore. And so they're going to go for another round of capital raising. And I think they're going to find that investors aren't willing to give the valuations that they were giving, a year or two ago. And so, that presents a difficult position for the entrepreneur. The convertible note, the safe, they kick the can down the road on valuation. Essentially what they say is, we don't know what the company's valued at today. We'll set a valuation cap, which is the ceiling, right? That's the highest valuation at which this security will convert. And we'll base it off of what the next round investors pay for the preferred stock that they buy. And we can get into that probably another day on the different securities and the different terms that you might see in those. But suffice it to say for now that is one way of deferring the valuation analysis, because you're right, it is really hard to do in the early stages.
Another one that's coming for an early stage deep technology company. What really doesn't have to be deep tech, right? For early stage, what are comparables to determine comp value or potential value?
What other, like looking at other companies in similar markets? It's really hard to do in the private markets, right? Because the information is not necessarily there in terms of valuation. I would start online, where I start everything with Google, looking up companies, searching for companies that are in the similar space. There are databases that track investments into companies like that. And so, I start with PitchBook. PitchBook is a resource that we use all the time that talks about all of the different companies, and who they raised money from, what valuations, who their investors are. It's a really good resource for companies who are looking for investors in their space, and also to try to get some sort of market analysis.
Yeah, we've got a good inside baseball question here, which is, if you seem to be getting, from different investors about the same valuation, do we have some collusion going on there? Are investors talking to each other? And if so, is that okay? The question, I think, is more your opinion.
So I suspect that if you're getting the valuation as being roughly the same from investors who might not know each other, then that is probably what the valuation of your company is, right? At the end of the day, in the early stages, in particular, the best indication of value is what a ready, willing, and able investor is ready to invest at. So if you're getting similar numbers, then I think that's probably right. Now, if you tell me that, pitched this guy and then you pitched his cousin the next day, and she came up with the exact same value, I wonder if that would be because they had a conversation, but I like to think no, right? I assume that the answer is no. And I guess this is something else that I was going to talk about in a few minutes, but sort of segues nicely. Know who you're speaking to, right? Know your audience. If you're talking to sophisticated institutional investors, I think it's a safe no to that question. If you're talking to a random person who says that she's an investor, then I'm not sure, right? It's not possible to know. So it's just a matter of know your customer, so to speak, know who your audience, know who you're pitching. This goes back to that confidentiality thing that Adam talked about a few minutes ago. You want to share the details with that you want to share the details that will excite an investor, but you don't want to share information that they shouldn't know yet. And that's a delicate line to walk sometimes. But for institutional investors, generally speaking, you can assume that they're not in the business of stealing your ideas, right? They don't survive as a venture fund for so long by taking ideas. But random cold email from a person claiming to be an investor, I would be much more careful about what information I shared with that person.
One more question on this topic. What's sort of the maximum you should realistically expect to raise if you're using a convertible note?
That's a really good question. So let me preface by saying I see far fewer convertible notes nowadays than I do safes, simple agreements for future equity. So not to go off on too much of a tangent here, but a convertible note is debt. It goes on the company's books as debt, but no rational investor is investing in an early stage company for the debt return, right? It's not a good use of funds for a 6% interest rate return or so. So smart investors at Y Combinator came up with this concept of the SAFE, the simple agreement for future equity. It's essentially a convertible note, but without all of the debt elements of a convertible note. So a convertible typically has a maturity date, it has an interest rate, it has a capped conversion price, it has a discount. And so the SAFE basically stripped away the maturity date and the interest rate and is essentially a contractual promise, right? I, the company, will give you, the investor, whatever security I give to my next round investors, the preferred stock investors who come in the next round, but I will give it to you at either a capped conversion price or a discounted price, whichever one results in more shares to the investor. So we see far more safes nowadays than convertible notes. That wouldn't have been true a few years ago, certainly where I sit on the East Coast, right? For folks out on the West Coast, safes have become ubiquitous. They are becoming ubiquitous here on the East Coast as well. So I think you're more likely to raise money on a safe. So that wasn't the question that you asked, so forgive me. The question you asked is how much would you expect to raise using a convertible note, but I'm gonna talk more about a convertible note or a safe because they're effectively the same in this sense. I would say that number is increasing. It used to be that if you were raising more than $1 million, investors would expect you to do a priced round. But we are increasingly seeing safes of a few $1 million. We have investors that invest that are seed and pre-seed stage investors, institutional investors who will only invest in safes in the first round nowadays. And they are often investing 2 million of 4 or 5 million into that safe. The question ultimately then becomes, what is the capped conversion price? Because from the company's perspective, that's really important, right? You want to set the cap at something sufficiently high so that it doesn't result in significant dilution to the common stockholders. Okay, so last thing on the business, right? One thing that often goes overlooked that I think you don't want to overlook is in an attempt to talk about how great your business is, very often companies will sweep business risks under the rug when talking to investors. Every business has risks. Do not hide from them. Investors will surely be thinking about these risks, and they want to know that you have too, and that you have a plan to mitigate them. Think about what types of risk there are. Is it technology risk? Is it implementation risk? Regulatory in nature, etc. Okay, that was all I wanted to say on business. Happy to move on to the next one unless there are more questions.
Nope, you're on a roll. Go for it.
All right, let's keep rolling then. The next one is also reasonably obvious, I think, right? The team. We talk about the importance of the team constantly, especially in the early stages. For companies who have not hit those observable performance metrics, the team is probably the most important thing to an investor. You have to demonstrate why this team is the right team for this business. The business idea obviously has to be a good one, but at the end of the day, it's the team that implements, and the best idea with the wrong team is not very likely to be successful. In the early stages, investors are making an informed bet based largely on the team. Investors will want to see a well-rounded team with the right combination of skills. That doesn't mean that the team has to be fully formed. Investors understand that you'll need to add people to the team over time, but they do want to see that the team in front of them has complementary skills, will work well together, it takes a long time to grow and scale a business. You have to have that good relationship. You have to have passion and motivation. You have to demonstrate subject matter expertise in your specific industry. Specifically with the team, tell the story of the founders, right? Circling back to storytelling. Share your background, share accolades about you, right? We talked about this before the session started, but you need to feel comfortable sharing your bona fides. Don't be obnoxious, obviously, but also don't be shy about sharing third-party affirmations that show your thought leadership or your skills. It's really important, and it's a way to demonstrate that others think highly of you and that you are a leader in the space. So embrace that and get comfortable with it.
One of questions coming. So when you're pitching, is it best to pitch as an individual or as a group where the person has their domain expertise as part of it?
That's a really good question.
Showing your knowledge versus, that we're truly a team.
That's a really good question. And I guess the answer is that it sort of depends, right? Oftentimes, the person doing the pitching will be the business-minded founder, and then at least in the initial pitch, and then as the company or as the investor does a deeper dive into the business, that's when they'll certainly want to be talking to the technical founders and anyone else who has the domain expertise. On the one hand, you don't want to have too many cooks in the kitchen, too many people who are trying to lead the pitch. Having a unified voice is important. But at the same time, you want to make sure that you have the people with the right information in that room. So if one person has that information, that's probably the smart route for the start. But then you bring on more people to show the true expertise of the team.
Is it advisable to ask the person you're pitching to or the investor group you're pitching to who's going to be at your meeting so you can tailor who to bring?
That's a great idea. Yeah, no, it's a great idea. You could certainly do that. You could say, I want to make sure that I have the right folks on our team there to answer whatever questions that you may have. I think that's a really good idea. Okay, so we started to talk about this a little bit before. Maybe I'll just make sure I didn't miss any of it, which is the audience, right? Know your investor, know who you're pitching. Not all pitches are the same. Pitching an angel investor will likely look different than pitching an institutional venture capital type investor. We talked about this. Do your research, diligence, know who you're pitching, things that you should know about the investors, right? Their investment focus, details about their other portfolio companies, the stage in which they invest, any geographic preferences, etc. Again, that'll allow you to tailor your pitch to the person that you're speaking to, which will hopefully resonate better. If you're pitching an investor who really knows your industry well, then you can assume that they know basic terminology and have basic knowledge. Even so, I suggest erring on the side of over-explaining until they tell you not to. But when raising money from investors who don't know the space particularly well, sometimes you don't have the luxury of choice, it's better to oversimplify.
Can you touch on, this is coming, the sort of the difference between pitching to angel investors versus institutional investors? Is there a difference?
Yeah, I think it depends on the angel investor, probably more than anything else. But angel investors tend to be high net worth individuals who may or may not have domain expertise or subject matter expertise. And so if you're pitching someone who doesn't have that knowledge, then the pitch is very different than pitching to an investor who invests solely in whatever space you're in. Right? We have investors, I'm doing a deal right now for an investor that invests only in fintech companies, right? We can assume, or a company that's pitching that investor can assume that they have deep understanding about fintech companies. But that's not true if you're pitching an angel investor who just happens to be a wealthy person. And so the pitch should be tailored to at least some degree based on the audience's knowledge and expertise.
Do you put family offices in with angels, or do you treat them as even a separate class for talking about the pitch?
I think this goes back to doing your research on the family office. If they have a domain that they focus in, or an industry that they focus in, you'll be able to find that probably, online and with a look at who else they've invested in. But for a family office that invests broadly across a wide variety of industries, then probably more like an angel investor.
Another question that's come in, and this may be technology specific, but how important is peer review validation, like an academic publication or news coverage, in helping you get your pitch going? Like, do you need to have it? Is it a threshold, or is it a nice to have?
No, I think it's probably, I suppose it depends on the industry, but I think it's a nice to have, that, you have other people who have shown that this is credible, thought leaders in the space who are reviewing and acknowledging the value behind what you're doing. This gets into a whole nother domain of, university licenses and things like that, which, does tend to add credibility to a company, where when that the technology emanates from some institution, some preeminent institution at that, there's certainly value in that. And I think investors like to see that, so long as the intellectual property, the chain of title to the intellectual property is clear, and the company has whatever rights it needs to use that intellectual property to actually commercialize and grow and scale their business.
I'm going to circle back to family office for a second, because there was another question on it, and this is maybe a little less about pitching, but is there a way to think about getting access to family offices, or pitches you've seen that have worked well?
Well, I think I'll speak more broadly as to finding investors, because I think it's the same logic. Finding investors is in some ways easier than ever, but in some other ways hard, right? Still, on the one hand, a lot of investors really don't take cold emails. That's changing in an attempt to broaden the reach of venture capital to more diverse founders and founders who historically haven't had access to the network, so to speak. And so many investors are opening their minds to taking cold emails, but remember that they see so many emails that it's easy to go overlook there. So a warm introduction tends to be I think the easiest way to get in front of an investor. Again, whether that's from some service provider, like a lawyer or an accountant or an investment banker or whomever, or really another entrepreneur who can vouch for you, who may be in the portfolio of that investor, that tends to be really useful. Maybe one of the last things, I know we're running out of time here. We started to talk about confidentiality. I wanted to talk about that in a little bit more detail. One of the few things that we've talked about here that's actually legal in nature. Understand that there is no assumption of confidentiality when sharing information with a prospective investor. I said this already, but I want to reinforce. Institutional investors like VCs are not in the business of stealing ideas, but they almost never will sign an NDA, a non-disclosure agreement. So they see way too many deals. It would be impossible to manage from an administrative perspective. You may do an initial pitch telling them about your business, but they may already have a company that is in a similar business or a competitive one. Or companies pivot into one another all of the time. So institutional investors, by and large, will not sign an NDA. And that's probably okay for an institutional investor. Right? Again, it's not they're not going to steal your idea, as long, and reputation matters, right? So understand their reputation, know who you're talking to. Be more careful with a person that you don't know, or who comes to you via cold outreach. We talked about being realistic. I guess maybe one thing to end on is practice, right? Practice in front of the mirror. Film yourself if it helps you. Rehearse, but don't have a speech prepared, right? Don't have a speech memorized. It is meant to be a conversation, usually. I've seen founders try to recite speeches, but then if they forget the next line, or if they're interrupted by a question, it throws them off completely. And if they freeze and they can't continue the conversation. This is relationship building, right? Develop a rapport. Go to pitch competitions. When you start having these meetings, start with your warm and friendly investors to the extent you have any, so that's partially practice. At the end of the day, pitching is a learned skill. The more you do it, the more you practice, the more you speak about your company and study your business, the more comfortable you'll be with it. And if there are two takeaways, right, it's tell a good story and build a relationship with your investor. That will go a long way.
So another question that's come in is there a way to create a sense of urgency among the investors that, you need to get in?
There's always that fear of missing out. If you come to an investor and you say, we're raising $4 million, we've got 3.5 soft circled, we want you to come in for the rest. There's definitely going to be some urgency there. They don't want to miss out on the opportunity to participate in a deal like that. That's not usually the case, though. Usually you're seeking your lead investor. In that case, unfortunately, oftentimes the investor will drive in terms of speed and urgency. So you should be having conversations with multiple investors, trying to find that lead. Once you have the lead, others tend to fall in place because of this exact issue, right? They don't want to miss out. Getting that lead investor is generally the hardest. I think there is some urgency at times. Unfortunately, I think that's changing a little bit in the negative for founders. Deals are taking longer than they were a year ago. Let me say it slightly differently. In 2021, we had a record year of capital raising. It was an amazing time to raise capital. This year, we are down from that year. It is not the best of times, but it's also not the worst of times, right? At last look, we were ahead of the numbers that we were at this time of the year in 2020, which was also a record year at the time. So it's still a good time to raise money, but depending on the industry that is. But deals tend to be longer. The time from term sheet to closing is longer. The amount that you're raising is coming down. Valuations are coming down. That's particularly true with life science companies, unfortunately.
Absolutely. Another question we've gotten that's come in is there, what are your thoughts on using video in connection with your pitch? Whether that's embedded in the deck or available afterwards, helpful, more of a hindrance? What have you seen?
I've seen it, and I sort of like giving the option for it, including here's a quick video if you're interested post meeting, or even pre-meeting, but it shouldn't be a replacement for the deck. I don't think. I think you still want to have the information that we've talked about within the walls of your deck, and then have a supplement of a video to the extent that would be useful.
I know I'm showing up to let you know that we are running out of time, and I want to thank everybody for joining us this afternoon, and thank you, Adam and Jared, for your time and sharing your insight with everybody today.
Thank you very much.
Yeah, it's a pleasure. And I meant it when I said it at the beginning. Please do reach out. This is the fun part of what we do. We love talking with entrepreneurs. We love talking about the interesting companies that you're all working on. So if we can be a resource, never hesitate.
Thank you.